I apologize here for everybody. To everybody. Thank you guys very much. I was making fun of my partner Matt earlier for being a real boomer when he screwed up something in a meeting, and now it's me messing things up. But I'm gonna blame AWS for being down. I had a nice system with sound effects and all this stuff up, but anyways, we're gonna move on. So we're here to talk today. It's approaching expiration, right? We have VIX expiration coming up here, and then obviously we have the monthly November OPEX, which is a decent size options expiration. We currently calculate about 30% of S&P Gamma and about 30% of spiders and Qs are all set to expire on Friday. And there's a lot of single stock Gamma that is set to go off as well. What you're looking at on your screen here is the ESE minis. That is what you see on top of the screen. And we are testing this 4,300 sort of 43 kind of 20 resistance area. And what this really is the spiders have a lot of call resistance at 470. And then obviously we have 4,700 is the big bar for the S&P index options. So we have this big kind of range in the morning note. We kind of specified this as a resistance range, right? It's just kind of like a big puddle of mud that the market can go kind of get stuck into. And that's kind of what is playing out. Now on the bottom here, we have our hero indicator. And what this is showing is the real-time deltas traded for the entire S&P complex. So that's the SPX index and SPY equity options. And what you can see is that to start the day off, there was a big rush of long delta trades, that's put selling and call buying, likely put selling, and that pushes the market right up into this 4,700 area. And then right around 11:30, the market has stalled. Options deltas pulled back a little bit, and now we're just drifting sideways. And then as we have been talking, the deltas have started to come in a little bit more negative, and you can see the market is kind of getting stuck a little bit. Now, if we look at the VIX options, obviously that is the big thing to talk about with VIX expiration tomorrow. There are a lot of VIX puts that are expiring tomorrow. One of our colleagues who's very adept at analyzing the VIX options complex noted that the VIX 15 strike puts as of yesterday, I didn't double check that before the call, had something like 350,000 contracts outstanding for tomorrow's expiration. And then there was another 150 or so at the 16 and 17 strikes. So there are a lot of puts in and around this area in the VIX. And that is a very interesting dynamic into this afternoon, because obviously this is kind of the last few hours to trade those VIX options before expiration tomorrow. So there is, I believe this is the driving dynamic at the moment, these VIX expirations, VIX call options, VIX put options that are about to expire. Now, with that 30% of Gamma expiring, if you look at the equity hub here, we can pull up the S&P 500 and take a look at this. What's really interesting, you can see that today's expiration is rather small, and that the biggest expiration on the board is the December expiration. There are, I believe, 3.5 million puts that are set to expire in December. So there's a lot of puts out in that date. And we have a fair amount of Gamma, again, expiring this Friday. But what we wanted to show initially was this. Now, what this is plotting out is our momentum indicator, but what you can really think of it as is the derivative of Gamma. So it's called speed in another way. And it's analyzing or showing us how what the rate of change of Gamma is. And what we think this is interesting for is these inflection points. And what the inflection points are is, you'll notice there's a very steep change here from roughly 46.80 down to 46.25. And that implies that there will be a pretty fast market if we break this 4,600 area. And the reason that we're starting showing this is because we're going to have this expiration, and the idea is that there should be an uptick in Gamma, an uptick in volatility into the end of this week and really to start next week. And with the positioning that we see in the market, there are not a lot of puts, and I'm going to dig in this a little more, but there's not a lot of hedges on at the moment. And so what we're eyeing is that if volatility picks up a little bit, we don't see all that much support, despite the fact that there is a high volatility, a high Gamma market. There's this inflection point down at 625, and you notice there's a change in Gamma here, which we think is a support area, and then a second drop down to this 45.50 area. There are big put positions that still exist, and they won't really expire on this expiration. So we think even if there is a drawdown at the moment, it's fairly limited. down to 45.50 area. But the fact that so much gamma is expiring, again about 30%, should pick up some volatility. And there is this gap that is a little bit concerning. If you look at where our current levels are, and I'm going to bring up our daily note just to talk about this kind of briefly. The chart that we posted this morning was this gap. Now I'm going to show this on a little bit of a bigger screen, but you'll notice our vol trigger, which is where we show gamma flipping, and the put wall. Yesterday's data for the put wall showed that the biggest area of put gamma was all the way down at 4,000, and our volatility trigger is at 46.20. So that's a good 2% below where we're currently trading. Now yesterday they picked up a little bit, and I think that's because of some short duration noise. But the thing that's got us kind of a little bit nervous going into this expiration is that there's not a big kind of zero gamma flip support down for about 2% from where we're currently trading. And the bulk of big put positions are really quite far down. So as you can see in this chart here, and hopefully this is clear enough, these are our big levels. So the call wall, which we're up against now, it's 4,700. Then we have this thing called the put wall, which is all the way down at 4,000. Again, I'm not really taking too much. I'm taking the latest jump with a grain of salt. There's the fact that put wall line can flicker back and forth so quickly is telling us there's just not very many big put positions right now. So we think that this market is underhedged. And so if there is a little bit of a downdraft, how are traders going to respond to that? If they're going to purchase put options, then that could really kind of pop volatility and send us down to that kind of 45.50 area, 4,500 area that we mentioned before. And the other thing is that because implied volatility, that is the VIX, as we showed here, it's pushing down to this lower bound. And we mentioned this morning in the note that the S&P index options are only trading with a 10 vol. That there's just not much vanna, there's not much juice there to sell, right? A lot of times we like to see implied volatility pick up a little bit, and then we can get the put selling flows to help catalyze and push the market higher. But at the moment, vol is pretty low. This risk reversal metric, which we talk about often, this is at a 5, and so what this is telling us again is that implied volatility is cheap, it's low. Call options relative to put options are being priced relatively high according to the data over the last several months. So what we're getting here is low implied volatility, we're gamma pinned, there's not much open interest happening at strikes overhead. So if we take a look at that, you'll see kind of what we are getting at there. There's just not much implied volatility left to sell, right? The other thing that kind of ties into this, which we're going to bring up at this moment on this next chart, is the fact that there's not a lot of roll at higher strikes. And what we mean by that is if you look at this absolute gamma chart here, we have call gamma plotted as a positive bar on the chart. Put gamma is positive as posted as a negative bar on this chart. This is our call wall, which is this substantial area of gamma here. And for the call wall to roll up, which is something that we consider a bullish signal, right? It opens up a new top end of our range. We would want to see some strike here, 4750, 4800, overtake this 4700 strike. And as you can see, there's just not much gamma there. There's not much gamma at strikes overhead. So the view going in, again, to this expiration is we're gamma pinned to this 4700 area at the moment. That pin is going to be released, right? Or the strength of the magnet is reduced. And on top of that, we have implied volatility is already fairly low. It's fairly condensed. Now, if we look at realized volatility, if we shift down here to this bottom chart, we can see realized volatility. And what that is showing is it is up a little bit from historic lows. So what you can see here is the red line is 1 month implied volatility. And it is down near, again, lows, but the way that the market is looking, the way that the market is respecting in terms of VIX, the forward-looking vol, it still seems a little bit expensive in VIX terms relative to where realized is trading. But again, SPX implied is trading like a 10, so that is lower. That shows that there's less of a vanna trade, so to speak. So again, the real metric here, the metrics we're looking at is the release of the gamma pin. Implied volatility is already pretty low. We don't see call options at strikes overhead. And so we're giving a little bit of edge to a pullback here, particularly with the fact that we see a little bit of an air pocket because put support seems to be pretty weak, and people may have to scramble for some hedges. The other thing to note on here as we flip over to Tesla is there's a lot of these stocks, NVIDIA, Tesla, AMD, that had these convex returns. They pulled back a little bit last week. They're trending, kind of flat so far to start this week. But those names have made a big move as of late. They're call heavy, and as that call starts to decay, as those calls start to decay, those positions can pull back. Those stocks can pull back as dealers unwind some of those long call hedges. So I'm gonna take a second here to look and see if we have any questions in here. Please put them in the chat. I'm more happy to help. Bezos is using the power for his rockets. That might be right, Barton. Let's take a quick look at Tesla because it's such a hot topic. What's interesting about Tesla is we did an analysis. You can find it on our blog that the open interest in Tesla has been obviously quite call heavy. But what has been fascinating is this idea that as Elon is selling off his shares, we are seeing a rally in the Tesla stock. We did this analysis. You can, again, find this on our blog. We're in the middle of doing an analysis of the flow yesterday. But the same thing happened in the flow yesterday in that these are the windows in which Elon sold his stock. We could tell that from the S4 filings. And as he's selling, the stock is going up, which is a fascinating thing. Now, what you'll notice here is this is the black line is the Tesla stock. The purple line is the Tesla deltas that traded in real time. And what you can see here is that the deltas were very, very, very positive as Elon started to sell his shares. And then as he stopped selling his shares, the deltas fall off. And it happened actually, again, the same way yesterday. You may note that the stock really popped around 245 yesterday. So we can highlight that move here. So this move yesterday, focus in a little bit more on this chart. This specific move yesterday, Elon started selling here at 1,010, and his final sale was 1031. So the fascinating part about that is there's a pop in deltas, which we're going to put a paper out about that a little bit later. But he top ticked the market by almost to the dollar. The same thing happened last week in this analysis. His sale of 1,000, I believe it was 71, was the high of the day as well. So that's happened twice. We've seen these deltas spike when his trades come for sale. Now, you wouldn't think generally that the stock would rally when Elon is selling, but we think there's a hedge unwind that takes place that boosts the stock up. And it's likely the bank that is facilitating his trade, his sale, is closing out those deltas as they sell the stock. Either they close it all at once, it pops the market, buying back selling put options that are a hedge, possibly buying calls of some kind. But those are providing positive deltas to the market, which Elon is then selling into. We've seen that again last week. You can read this paper, this post on our site here. But also, this current, yesterday's trade as well. So this flow is then interesting. We'll see what he did later today. But there's this concept that has been prevailing or pervading, I should say, that Tesla is really controlling a lot of the swings or influencing a lot of the swings in the S&P 500. We're going to write an advanced analysis on that. But what we can say is that there's obviously some correlation. We are seeing what's called dispersion trades hit the market, wherein people are buying or selling S&P volatility, that's buying or selling S&P calls and puts, and using funds or matching those trades off with single stock volatility, particularly in the FANGs. And so there is this interesting volatility dynamic, and obviously with all the vol in Tesla and the fact that it is the top 5 or top 7 maybe holding in the S&P, that there is a lot of correlation and links, to the movement here. But we're doing a lot to analyze the way that Tesla affects the S&P now. So I'm going to turn over here and take a couple of questions. Take a look at Shop, Barton asked. Let's take a look at that stock. See what it's doing today. It has had a very good run as of late. As you can see here, I believe earnings were back on the 28th. So we'll take a look at Equity Hub, and maybe we can give some people an idea of exactly what we look for in these gamma squeezes and how you may play them. I want to bring up one thing. We are in the process of beta testing our Hero product. So Hero is going to launch. Hero is the real-time options delta that you see here. It's going to launch on our website in about 4 weeks. We're going to start beta testing very soon. And this will have a menu of stocks you can watch for Hero. If you bring up the site, it will show the Hero signal for the entire day. It's going to be really, really cool. It's going to be the first product that I know of that will give you information as to what the hedging flows are in the stock in real time. So let's take a quick look at SHOP. Obviously today the 1700 is the high, and what you can see here is that stock is rejecting off of this put wall key gamma strike. Now, along with some of the other research we're doing, we have a statistician on staff who is helping us in analyzing a lot of this data and information. And what he has found out, and what we've figured out, is that this key gamma strike has a high correlation with the movement of the stock for the next day. So when this key gamma strike moves up, we have statistically shown that for stocks that have a lot of concentrated gamma in the short term, the correlation is somewhere between 75 and 90% of the forward one-day return. In other words, if the key gamma strike goes up, we're statistically proving now that the stock tends to go up as well. So what you can see here in SHOP is that the key gamma was 1500 and then ticked to 1550 2 days ago, and then yesterday our data showed this morning when you came in that the key gamma strike was 1700. This is telling you that options are building up at strikes overhead. Now, the call volume and the put volume is not particularly large. If you compare this to certainly like the Tesla Gamma or Apple or one of these other names, you would see a lot more open interest. But the fact that this key gamma strike keeps rolling up is telling us that along with gamma being concentrated on Friday's expiration, that the options are building up at higher levels. And this is effectively telling us that the options range is pricing in a higher level for the stock. So we would look for a reversal when the key gamma strike rolls down, but this stock is more or less falling in line with what we'd expect given the data. You can see here in this momentum indicator that 1700 is where a bunch of our levels lined up. This morning the stock opened at 1650. It rallied all the way to this 1700. You can see there's this inflection point where it's rejecting, and we think that's going to kind of hold into this area is what I guess kind of 1680 to 1700. It's kind of got the gamma magnet on it now, so to speak. The issue, and I haven't checked implied volatility here with SHOP, but if the implied volatility is high, particularly in calls, as an implied volatility comes down, this is the Vanna trade, implied volatility comes down, dealers can unwind some their short call hedges, which is long stock. So as the implied vol comes down, they can sell off some of their long stock hedges. So something to think about there. John, you asked a good question about zero gamma and the vol trigger. So let's take a quick moment to discuss that. I believe in the blog here we posted a interesting chart about the volatility trigger. Let me see if we can pull that up while I talk about it. But for those of you who are subscribers, we have two ways of looking at where gamma flips. One is called our vol trigger, which is our proprietary measure of volatility of where gamma flips from positive to negative. The second one is zero gamma. And there's a reason we have two different levels. If you think about, and I'll just show if I just show the gamma indicator, it might be a little bit easier. But if you think about the concept of a gamma flip, we'll use this chart as an indication, right? This is a measure of total gamma in the marketplace. And what it shows is that as the market goes higher into the 4,700 area, gamma gets more positive. More positive gamma indicates higher amounts of hedging for market makers. And the way you hedge positive gamma, as many of you know, is to sell into the market as it goes up and buy the market as it drops. This is what suppresses volatility in pins. So the more positive gamma we have, the more dealers flow should constrict the market movement. Now, as the market moves lower, as price moves lower in the S&P, the gamma decreases and volatility should increase. You can think of this also as a transition of options from calls, there's a high concentration of calls around 4,700, to puts. There's a lot of puts obviously down below at strikes below, right? So as we transition lower, there's this point, zero, right, where gamma flips from positive to negative. So what does this number actually mean? Well, zero gamma implies that dealers have nothing to do, right? No gamma to hedge. So they should have no impact in the market. So when you originally started with SpotGamma, we figured that there shouldn't be any reason for zero gamma to respond as a level because dealers have nothing to do there, right? In theory, there's no hedge to make. But what we did find and what we used as our proprietary indicator was this idea of vol trigger. So what the vol trigger does is we load in all available S&P options into a portfolio, and we stress test that portfolio to figure out at what point would be the last level at which dealers would hedge, right? There's an inflection point actually in here, if you model this out, where you can see that, okay, dealers are going to keep buying as the market goes down, right? But there's a point at which they kind of close that last buy and they don't have any more trading to do, right? No more hedging to do. And that is what the vol trigger is. The vol trigger finds that last support point. And that's why we consider that a support level, because again, we find out and we look at, okay, if we're the market makers and we're hedging, the vol trigger is the point at which we stop. Typically, it's a little bit above where the zero gamma line is. So when we originally started the service, we only had the vol trigger. We said this is the last hold between, dealers supporting the market, vol triggers supporting the market, and if this breaks, it triggers volatility, right? If this level breaks, it's the last line of support. Now, what we found was, interestingly, that the market tends to respond to the zero gamma line as a support and resistance line as well. And our theory there is that it's a bit like a 200-day moving average, right? The market knows where a moving average is and they respond to it. Should the 200-day moving average mean anything? No, but everyone watches it. They believe other people will buy in there, and they treat that as a support and resistance line, and we think zero gamma is the same thing in that respect. So that is why you get both metrics. For us, if we're going to bet on volatility upticking, if the vol trigger breaks, that's where we believe volatility, the market will spike and the initial drawdown will occur. So I hope that helped out, John. So Alex asked if we're giving edge to a pullback this week. We are giving edge to a pullback this week. At the end of this week into early next week, there's a good 2% gap down to 46.20, which is the current vol trigger. Obviously, these levels are going to change a little bit into Friday, but we would look for a test of that vol trigger. If that holds, then the bulls, we think, still have the mantle or the baton. If the vol trigger breaks, then we would look for something more down to that 45.50 area. Yeah, so good question, One Shot. He says our algos are complex. Do we have a consolidated algo that shows sentiment or directional bias? Let's look at this Vanna model. I think this is a good point to talk about this. So we talk about increased resistance, and in that resistance being dealers constricting volatility. So here we have our Vanna model, and what this is showing is the amount of delta change for a change in implied volatility, right? So if you look at this as the next expiration, this is the deltas that are in the entirety of the S&P 500. So this is not exactly what market makers hold, right? Because obviously there's a lot of players mixed in there, but this is the delta of the S&P 500 as a whole. And what you see here is that as the market goes up, the delta notional of that S&P options complex increases. And what that is telling us is the market is getting longer calls, right? As the market goes up, these calls get in the money and they'll generate positive deltas that needs to be hedged. So as the market goes up, market makers need to hedge out this extra exposure, and they will short futures to hedge themselves. The higher the market goes in this example, the more futures will be sold. So if the market goes up to 47.20, dealers are going to sell some, sell futures, and as the market then pulls back, they're going to buy futures back, right? So this delta exposure is telling us there's a lot of resistance in the market. And you can see there's a skew here to this chart, and we refer to this in our notes often, that this skew is telling us, is there resistance or is there support for the market? In this case, there's resistance based on this, right? If you just did nothing else but looked at the skew of this chart every day, you could figure out which way the market, which edge would be in the market, right? And in this case, we say there's resistance above. That is kind of the edge. Now, if we shift down and look at Qs, there's a very subtle shift here where the tilt is the other way, right? It's almost the mirror image of this. If you can see, the cup is tilted. And what this is saying is, and if you look at the structure of the Qs, there's a lot more puts in Qs than there are calls. And so as the market drops in this case and vol spikes, Dealers who are short puts need to sell futures in order to hedge themselves to the downside. And then if the market starts to rally, they got to buy those futures back. And so this is telling us that dealers are going to be pushing or running with Qs, right, as opposed to supplying supplying liquidity that suppresses volatility as they are in the S&P. It's a distinct difference, and you will see times, particularly after a drawdown, you look at 2 days ago, how steep the skew is here, right? And hopefully you're getting this idea that you can look at this chart and say, which way is the market positioned? Are we positioned for volatility, and do I run with that volatility, or are we positioned for a yawner of a day like we are today, right? You can see that skew and how that's positioned. And we think that this snapshot, if you were to look at one thing every day, you come and look at this, go, okay, I know which way the market is positioned. How do I want to choose to interact with that? Trying to catch up with some of these extra questions. Why are the VIX and spiders moving the same way right now? That is a good question. Let's check out and see what the VIX is doing. We can see the S&P keeps trickling higher. And as you can see, the deltas are actually coming off as we go through the day. And this is something that we get a lot of questions on. But this is part of we believe this dispersion trade where people are trading index vol against, S&P vol specifically against equity, single stock volatility, and or VIX in the volatility complex. Again, if you consider that S&P at the money vol, options vol was like an 8 or a 10. Excuse me, I believe it was a 10 this morning. I believe it was an 8 when I last looked. That is very low, right? And you compare that to the VIX, which is still up around 16. And there's that steep contango in the VIX futures complex that there's an arbitrage arguably there, right? Between what the SPX options are trading at near term and where the VIX complex is trading. So let's just take a look at where the VIX is right now. And, when we're approaching VIX expiration as we are now, there are so many VIX puts at the moment expiring tomorrow that, there's a lot of position adjustments ahead of that, particularly with so many. I believe it's around 600,000 plus VIX puts that are expiring in the morning. And again, 16 is a big level for those, and 15. But in general, because we have VIX, I would discount this. But anytime you see the VIX moving higher along with higher S&P prices, that can be a signal that calls are being bid. Certainly, if you look at an example like Tesla, where vol went to 300. And the stock went up, that stock literally crashed higher. It's a chase for liquidity. So, because of expiration, we're discounting that move a little bit. But anytime you see the VIX go up, like we saw the NASDAQ VIX go up along with the Qs earlier this month, in a sign that there was a lot of people chasing call options there. And that can be a signal that the market's a little overheated there. So John, another good question there. Why do we refer to things as, a lot of people talk about GEX. And we refer to something as an SG index. It's really quite simple. There's no link that anyone has found to. So let me pause here again. GEX, as most of people see it, is this number here, gamma notional, which is typically referred to in a number in the millions, right? So gamma, the GEX is 400 million or billion or whatever it is. The idea there is supposed to be an inference of how much market-making hedging has to be done, right? What's the gamma of dealers? So every point in the market, they need to buy or sell $400 million notional. I've never been able to find an actual link between the volume traded for 1 point move up or down and this gamma notional number. This is just a big number to spit out. It doesn't. 471 million doesn't really mean much. So that's kind of the basic market version of this metric called GEX. Now we have a gamma index. We indexified basically this gamma notional idea so that there's an upper and lower bound. So if you were to look at the gamma index chart on our site, you can get an idea of exactly, and I believe that is under, here we go. You can get an idea of the range of gamma, right? So -4 to +4 is basically that range of gamma. It goes a little bit beyond that. But this has now been somewhat indexified, right? So an SG index of 2, we know the daily 1-day return will fall somewhere in here. Now, Gex and Gamma, again, in and of themselves, don't really even mean anything, right? What matters, or what the implication is how much is the market going to move based on how much Gamma there is. If you believe that there is a correlation between the amount of Gamma in the market and how much the market is going to move, then all you really care about is the implied movement from the market. And we made a note of this morning, that our SD implied move for today, because there's a fair amount of positive Gamma, is about 62 basis points, and the I believe 68, and the S&P options are trading at 62. So the market and Gamma, our volatility estimates are kind of in line, and where those models start to break, so to speak, where our forecast will start to change, is knowing that Gamma is going to change next week. And so if implied vol is still at 10 for next Friday's options, but we think volatility is going to increase because Gamma is changing, then maybe we have a little edge there on the market, right? Maybe buying options for next week makes sense because we think vol is going to tick up and the market as a whole isn't pricing that. So hopefully that gives a little breakdown as to what we think there. How will Hero be different? So the Hero dashboard, I would love to show you guys. We're not quite ready to show that today, but basically what you're going to get is a menu of stocks to choose from. Right now we're beta testing with 100 stocks. You click on the stock, you get the live Hero chart, and you can flick through different charts. There's alerts, there's all sorts of different things in there. And the other neat thing, Bookmap is a great friend, a great partners of ours. The Hero signal in here has worked really well for a lot of traders, and so that will continue to operate as is. We're just supplementing or building out a little bit more of a dashboard, right, for the Hero indicator on our website. Question on where the put wall is. So the big levels for Tesla at the moment are still around the 1,000 strike. I've been trying to figure out exactly which options are driving, which put options are trading here around. I believe they're puts being closed with Elon's sales. There's a lot of November put options being sold when this stock rallies. Now, at the moment, you can see all of our levels are around 1,000. The put OI is much lower than where the market is at the moment, and this 1,000 level has not changed. The Hero signal for today for Tesla started very positive off the open, and what that told us is people are getting long trades, long deltas, right? And you can see that the long delta started in the morning. The deltas went a little bit negative, and the stock came lower. And then, there was no trading, which is what we get when the Hero's flat. And then right in the last sort of, I guess it's about half hour, 50 minutes now, the delta shot up, and the stock has pushed a little bit higher. So this is telling us that traders are positioning long deltas. So that's call buying and put selling in Tesla at the moment. I don't know if that's because people think that he's done selling now, or it's just meme mania or whatever it may be, right? Who knows? But the interesting things here are that the options market and the liquidity should be down around 1,000. And what's so fascinating about looking at this book map is you can see there's a big pool of liquidity above. That's what this bright white light is. A lot of posted liquidity up here, and then the only liquidity down below is down towards 1,000, where all these options contracts are, and you can see where all the volume shows up. So I personally think that we would revisit this 1,000 area, but these are quite strong deltas at the moment. If you wanted to sort of short or play mean reversion in the stock, you would want to see these deltas start to turn down to break south as an indication that the stock might turn. So question here, just as I described the zero gamma trigger, can one imply that a max gamma pivot by finding the highest concentration of selling on the DOM ladder? I believe that would be the case, and I think what you're kind of saying is, where does this thing peak out, right? Where's the top area to get stuck? Now, we showed you the chart before of the gamma by strike, and for 4,700, that's the S&P peak gamma line. For the spiders, it is 470. So if you look at the breakdown of gamma here, and if we go to I'll show you what I mean here. So you'll note here that we've just now broken the 470 line in spiders, and so I don't think the market should move a whole lot more through this area. Try to get this on the chart a little bit better here. because of the concentration of gamma at this line. Now, if you look at the breakdown, again, we already showed this chart in SPX, but if you look at spiders, it's the same thing, right? This is the 470 strike. You can see how much gamma is posted in calls at that line. So 470 in spiders is basically right where we are in the index. Now, this is clearly a market that is trending, higher, but this is all kind of the area where we think things should get stuck in this mud, right? There is this interesting deal of deltas trading south. The VIX is catching a little bit of a bid here. There are all those VIX expirations, and so there could be a little bit of something wonky kind of tied to that. But, a grind higher is possible, maybe a little bit higher, but we think, again, because there's so much gamma at 470 spiders, which is actually bigger complex than the SPX right now in terms of gamma, that this should be, pretty sticky areas. Let's see here. How much do I think OTC positions? Jay, that's an excellent question about OTC positions. There are a lot of OTC positions, particularly when you start talking about the dispersion, trade sprays. There's obviously variance swaps and the like, and we've not had a great way of measuring how much or how large those positions are. We made some attempts to figure out how big the OTC market is and incorporate that into our data and analysis. Fortunately, we find that the models as they are do work very well in terms of volatility forecasting. If you look at our models yesterday, we called the high and the low within, I think, one handle. And again, today we said, we're looking for pretty low market movement. And so consistently the levels hold up. Now, the issue I will say that we are working on is occasionally there are these times where calls are bid much harder than our model will pick up. And this is the NASDAQ, VIX, and NASDAQ shooting higher early this month. And that can overrun some of our levels. We've only really seen it twice in the last, say, year and a half. There was a little bit of it this past week where our call wall was breached, earlier this month on the 11% NASDAQ rally. But if you all remember, at the end of March, start of April, there was just this rip-roaring rally, and Algos had just gone under. And we believe that there was a giant hedge unwind and de-risking by banks that led to a bid in S&P calls and or put sales, and that our models didn't kind of pick that up the right way. That was the toughest stretch of our models kind of being run over ever, and we firmly believe there was this kind of artificial flow kind of entering the market. So we're adding a whole bunch of implied volatility overlays into the models, but 95% of the time we believe that they seem to work very well. And while we are trying to incorporate OTC positions and the like to get more data in, we hesitate to change the model a great deal, right? It's kind of like if it's not broken, don't try to fix it kind of thing. So the presentation, Ian Brown, I'm not sure if you're referring to the book map chart here. We're showing the book map chart primarily because it has the hero data on there, and a lot of people like to catch a look at that. So good question. The put wall is very low, and usually the gap in the put wall is not quite as big. The P trader asked, and that's referring to our morning note in this daily index. Now, we briefly described what these walls mean. Call wall is where most call gamma is concentrated, the strike at which most of the call gamma is concentrated, and the put wall is where most of the put gamma is concentrated, the single strike that has the largest amount of put gamma, I should say. So we had talked about this on our subscriber notes, but what you can see here is that as the call wall moves up, the market will typically move and hit that line. This is like the gamma magnet idea, right? Occasionally we'll pull back, but typically we'll run up and we'll bump up against that line. So if we zoom in here a little bit, you could see that end of March, April period where, this is it, where the market just kept kind of ripping higher. This chart obviously doesn't give a lot of great scale here, but you can see that this is the move that we're talking about. But what P Trader is asking about is this gap. And the fact that the most concentrated put gamma level is down at 4,000 is remarkable because gamma's highs for at the money in near-term options. The 4,000 strike, I believe, is mostly concentrated out in December. So that's a deep out of the money option. And so there is a big open interest position there, right? but the gamma should be pretty low. So if we had a market that had a decent amount of hedges, you can see that there tends to be a fairly tight relationship that as the market goes up, the vol trigger shifts up, which tells us we're being supported, and then the put wall rolls up, which also tells us we're being supported, right? Puts are filling in underneath. Hedges are coming in. What you see sometimes when the market gaps higher, like it did this past month, right? We're consolidating in here, is that the people start to chase calls, and calls get bid up. People run into calls. No one wants puts, right? Who wants to buy protection when the market's just shooting higher? We all believe the market's going to go higher, and now we have this gap, right? There's no protection here. So stage one, if we start to sell off, would be I need to buy some puts, right? And when people buy puts, that adds a negative gamma into the market. Dealers to get a short stock, short futures to hedge, and that can start the drawdown. I don't think we get a major drawdown. I'm kind of in the ultimately the Santa Claus rally. Camp, but at the end of the day, it's path dependent, right? I think first thing first, my view is closer to only a few weeks out that we could get some consolidation, some pullback until these levels tighten up. And that could actually provide a pretty good base. If vol spikes a little bit, there'll be some Vanna trade in there, right? That can help to get the Santa Claus rally going. So that's kind of what we're thinking at the end of this week and into early next week. Captain Ron Cat asked about CL futures. We do not have the hero for commodities at the moment. That is something that we are considering for next year. Varsha Reddy asked, the market stalled at 4,700 for several days and broke through it today. Does it mean it no longer is a pin into Friday? Absolutely not. We still think it pins this area into Friday. Again, that 470 spider is a huge line. So in our morning note, we specified it's this kind of range where we think things are going to get stuck. In other words, we don't see like a 1% pop coming at all. We would expect, and I would expect, that there'd be a little consolidation here now that we've hit 470 spiders. Swan asks if I can look at the NDX. I don't have the NDX loaded up at the moment. And we showed the Vanna chart for the Qs, which is supporting a little bit more relative volatility. Do we see any changes to reading the SPX once the SPX options trading after hours starting next week? That is a fantastic question, Kevin. I don't think there will be a big change immediately. As of now, you can start trading S&P options at 2 in the morning Eastern time. And we've watched the hero at night. Nothing really happens. I think market makers have to hedge if there's a big futures change, but there's just not a lot of volume overnight. And so at the moment, at least in the very short term, we just don't see much happening. If you look at the NASDAQ, they rolled out the triple Q expirations for several times a week, and that volume is still not picked up to the level of what S&P, the S&P 3x weekly volumes are. So I think that stuff takes a little bit time to grow. Yeah, Apex Lex, good question. How do we determine at which level market makers will hedge their positions? It's not one for one. I think that there are bands basically, and at these big levels here, the market makers will put a bunch on, right? I know for basic fact that as a market maker, you want to hedge as little as possible, right? Because those are transaction costs. And so if they feel like it's drift and they can just hold on and not have to hedge, then I think they choose to wait it out. They can't take that much directional exposure. And so I think there are pockets of areas, right, where they're going to step up and adjust their flow. So, for example, you look at how the market came in here, and this is kind of a big area of gamma. The deltas change and the market flattens out, after this move, right? So there's this concept of gamma bands out there where I think that these levels tend to correspond to gamma bands because you see the market react at these big gamma levels so often that I think when you hit these areas, right, these strikes with a lot of gamma tied to them, that will invoke the hedges. George, I hear you on including some of the extra levels in the file. We can look at doing that. So in general, when you get a lot of gamma expiring in anything, so the question is, how does all the gamma expiring in single stocks affect the market? If you look through some of these, Tesla has 37%. I think Apple's probably up there as well, 30%. This is just, typically in single stocks, we think that the market makers are long calls and puts as opposed to the index where we think traders are long calls but short puts. And so if a stock has a strong rally and you get an expiration, a heavy duty expiration, a lot of calls or puts expiring, all that gamma expires into Friday, and then the stock kind of refreshes on Monday. We've done some studies of this, particularly like AMC, where you see that on Monday, Tuesday, Wednesday, the volatility is very high, and then the volatility condenses as we go into options expiration. So it's almost like the monthly cycle just condensed to the weekly cycle in the single stocks. We look for direction changes. Depending on what the trend is, oftentimes we think that gamma squeezes the most on Monday, right? Because traders like to run into calls, thinking that, I got 5 days expiration, so these calls are worth more. So they'll run into to call positions there. So, there's a cycle for sure, and it's a resetting right now. In Tesla, we had mentioned many times that that's the greatest day for a gamma squeeze. In like AMC, you'll typically see that the vol is pretty expensive. And so oftentimes we think, hey, shorting AMC options on a Monday because the vol is so expensive and the name tends to pin 40 week after week after week, that can be an interesting time to sell vol. You can see 40, almost 50% of gamma expires in AMC on Friday. All the gamma is tied to 40. Yes, the thing's at $44, but we've seen it happen over and over and over again that the stock will drift back down to this 40 area despite trying to pull away time and time again. So hopefully that helps to answer that question. Yeah, Barton, good question. He asked, when's the most important time to hedge? End of day, start of day, end of day are the two most important times. End of day in particular because the market makers have risk sheets. They have risk managers, people watching their books to make sure they're not taking on too much exposure. Those runs happen at the close. So if your risk isn't shored up as a market maker, you're going to get a tap on your shoulder just like you would if you were a hedge fund guy carrying too much exposure, right? You cannot be exposed. You'll get margin calls just like anybody else. So they make sure that their books are all lined up and hedged out at certainly 4:15 each night. So that end of day hedging is particularly important. All right, so we are going to leave it at that as it is now just a little bit after 2 o'clock. We sincerely appreciate all of your patience with our getting a little bit late getting started. We apologize for not having Imran on. Again, these technical difficulties. I'm very happy to hear that AWS was down, so that just wasn't me screwing things up. But we will be back on track for next month expiration. Maybe we can see about having Imran on later this week. Please, if you have a chance, leave some questions or comments in the description, or leave your questions in the comment section below. Keep an eye out for 30 for 30. That is a educational series, 30 years of education in 30 minutes that we have on our website. And we're also going to be launching an educational series that you can sign up for. That will be rolling out in the next few weeks. If you go to spotgamma.com, make sure we have your email. You'll get notifications about that. And then finally, we're also going to be launching Hero in the near term. Call it 4 weeks. We're going to be beta testing very soon. We'll have a bunch of emails out about that. We're super excited about education and the Hero signal. And we think that you all will love both of those. So thank you all very much for your time. We appreciate it. Good luck trading this week. If you have any questions, send us an email, info@spotgamma.com, and I am at SpotGamma on Twitter. Thanks, everybody.